Thank you guys for coming to today's class about Darwin Cloud. And for a lot of people that are on this call, or at least some of them, some of what we're going to cover it might be a little bit redundant because you've been using multi-company accounting. But we surveyed people and we found a huge number of our customers weren't even aware that what's called multi-tenant accounting was even a possibility in Darwin, and that's why we decided to put this class together. So today, what we're going to go do is spend a little time going over multi-tenant accounting, and then tomorrow, for anybody who wants to or has like really in-depth questions or wants to set up intercompany accounting or set up more companies in their database, tomorrow at the same time, we're going to do a class that's just basically a training class, a Q&A for anything anybody wants to talk about multi-tenancy. So in Account Tech Week, we say all the time that you could have multiple companies in your account tech, but the technical term for that is multi-tenant or multi-tenancy. And really what it means is you log into the software and you can have an unlimited number of companies all run in Darwin all at the same time. Now, if you think about back to other accounting softwares that you would use, like QuickBooks or Peachtree or Xero or Lone Wolf or whatever, for every company that has its own set of financials, you have to have a separate you have to have a separate copy of the software. And you log out of this company and you log into that company, you log out of this company, you log into that company, and each of the companies is in like a database silo. But multi-tenancy means you can have all of your companies all in the same database all at the same time. And the software, Darwin Cloud, keeps all of the companies in at the same time, but keeps their financials separate. So let's talk a little bit about the benefits, right? Probably pretty much the main benefit if you're a staff person is you can stay in one software program. You don't have to jump in and out, and you can do all your work all in the same place. And you develop a certain efficiency and speed when you're using one system for all your accounting. But the other big thing is about analysis. So you can run reports that are in Darwin Cloud to let you see all of your companies side by side. This is a big deal, right? So if you have a lot of different real estate companies that you have started or purchased over the time, it's pretty great to be able to see which of your companies are making money and which of them are making a lot of money and which are making a little bit of money. But multi-tenancy also lets you do roll-ups. So if you want to see how all of your companies are doing together, or for instance, if you want to see how all of your real estate companies are doing, or all of your title companies are doing, roll-ups allow you to combine multiple companies' financials into a single report. Now, obviously, you wouldn't use a roll-up for a tax return, but it's great for analysis and guidance. The other main benefit of having multi-company accounting software is well known to many of you, which is called intercompany accounting. So for any of the old school's accountants that are in on this call today, you know that when you have multiple companies, it always happens that one company pays a bill, but part of the bill is for one of your other companies. So the company that paid the bill has to charge the other company to pay us back. And you normally do that with journal entries on the balance sheet of each company separately. It's called it's nicknamed pay to pay from accounting. But it's a pain in the neck and it's really time consuming because as soon as company one pays company two's bill or pays it in part, and you forget to make that adjusting journal entry on both sides, on both company one and company two, the ledgers get out of balance and the amount of time you spend trying to rebalance is just nightmaric. So AccountTech for Darwin has added this feature where any of your companies can pay bills for any of your other companies, and Darwin automatically invoices that other company to pay you back. And in the company that paid the bill, it automatically posts a receivable so that you don't forget that that other company owes you money. We'll talk a little bit later if we have time about some of the ways that you can use intercompany accounting creatively to, in a sense, automate all of the accounts payable for all of your companies all in one place. So next, I want to talk about for a second who should be using multi-tenant accounting. So a lot of AccountTech's customers are big on mergers and acquisitions. I saw Keith Thompson is on the call, and Mike from Coldwell Banker Schmidt is on the call. These are companies that continue to grow by buying other companies up. And it always happens, or it almost always happens when you buy somebody, that you have to have a separate set of financials because with each M&A deal you do, you have different partners, different ownership. So you have to have a separate set of books for each of the acquisitions that you do. And so multi-tenant accounting is critical for that. But nowadays, all the most profitable brokerages also are in multiple lines of business, right? We have a mortgage company, we have a title business, we have an insurance business, we have a property management business. We might have a whole separate company where we only a whole separate company where all of the agents in that company are in semi-retirement. So we have the semi-retired agents drop their membership in the franchise so we don't have to pay royalty fees on them. And we have them work in a separate company so that if they ever do get a deal, we can run that through a company that's not necessarily associated with the franchise brand that we normally use. So most everybody nowadays, even if you don't own a mortgage or a title business, maybe you have a separate business that owns rental properties that you just own separately and they're run under their own financials. All of these different kinds of businesses can be standalone companies in Darwin, and you can do all of the accounting for them all in Darwin, all at the same time. So M&A companies, I'll tell you another great use case. We're working with these really brilliant guys who have a franchise called Iron Valley. And so they want all of their franchisees to have unified professional accounting. So as part of their franchise offering, when someone signs up to buy a franchise from Iron Valley, they also get Darwin, and which means they get the tools to do professional accounting. And it also helps the franchise owner have some visibility when they're coaching the franchisees to help them figure out ways to be more profitable. They have visibility in the financials in a very consistent way. But also, again, mergers and acquisitions or any of your different companies probably have multiple stakeholders. Like the people that own your real estate companies might not be the same owners that own your title company. Or so maybe you have a partnership on a title company or a mortgage company that's different than the partners you have on your real estate company. And one of the key things about multi-tenancy is that when people log into the system, if they're an owner of this company but not an owner of that company, or they have an interest in the title company but they don't have an interest in the mortgage company, you can give them visibility and give them reporting, but only on the companies where they have some stock. Okay. Intercompany accounting is probably the most important technology in Darwin um, for multi-tenancy. So what this allows for is you could conceivably have one company in your company that pays the bills for all of your companies. So one company pays the bills of all of the companies. And when you're done entering the bills using this intercompany checkbox that's on the accounts payable screen, the screen automatically charges the other companies to pay you back. And it also automates the process of getting reimbursed from those companies to make all of the accounting entries that you need for pay to and pay from all to be done in one place. Um, Before we go any deeper on that, let's take this second to pause for a second. And Teresa, Adam, you want to let me know if there's any questions in the chat or any questions that have come up from people so far with what we're covering?
Nothing in chat so far, but if anybody has any questions and want to unmute themselves to ask it, you can go ahead. If not, we can continue.
Well, let's keep going then. So let's talk about some of the main things that you want to see when you're running profit and loss reports. I think everybody has probably seen in Darwin, you can run a profit and loss by month report where you have January through December across the top and you see all of the monthly P&L side by side. Or sometimes you'll run a P&L by office and you'll see all the offices across the top and you can see how each office is doing on their P&L. But now you can do multi-company P&Ls. And in the most recent version of darwin.Cloud, we've improved it so that instead of running a P&L where you have all of your companies that you own all on the P&L at the same time, now we've added this multi-select functionality, which is new to darwin.Cloud. And what it means is if you want to see some of the companies that you own on a profit and loss statement, but not all of the companies you own, you can now dynamically select which of the companies you want to have on the profit and loss statement for side-by-side reporting. So when you run one of these reports, it has a balance column that rolls up all of the companies, but then it shows all of the companies independently. So a classic use case of this that we always see people doing is they'll run a P&L by all of their real estate companies, and then they might do another P&L by company where they do all of the different prop management companies, because a lot of times people have multiple properties that they own and rent out, but they have the properties held in separate LLCs, and they want to run a separate profit and loss report for each of the properties that they own. And likewise, they might want to run a company P&L for all the title companies they own or all the mortgage companies they own. Because some companies, especially multi-state companies, might have mortgage operations in multiple states. So if you can see in this image here, you get a balance column where you have the roll up of all of your companies, and then you have a column for every single company that you've selected in the drop-down to run. Okay. Now, also new to darwin.Cloud is multi-company balance sheets. Now, it's funny to think about running multiple company balance sheets since, of course, it's an anathema sort of to like doing your taxes, right? Because you would never combine balance sheets across companies when you're doing your tax returns. But it really does have some benefit. For instance, if you've got a lot of different companies and you take a look at their balance sheets side by side, it really pops out at you when you're doing side by side balance sheets. Do any of your companies, are they having some problems with their cash balances? Or any of the companies that you own carrying very high accounts receivable or very high accounts payable. So if you are a growing enterprise and you have 10 real estate companies and two mortgage companies and three title companies and five property management companies, it's a lot to keep track of. And so with multi-company balance sheets, it gives you a very quick snapshot. For instance, you can see if companies' payables are way too high, and it could just be their company's payables are way too high because they haven't maybe reimbursed headquarters for all the intercompany accounts payable that they paid on their behalf. So seeing the balance sheet side by side gives you a really nice way to get into those numbers about those things that you can really control, like receivables and payables and cash. Okay, let's keep going. So the next thing I want to talk is about regions. So as your company gets big, you probably want to run reports on a geographic region. And the thing I want to point out here is you can have regions is a way to think about reporting, right? So normally we run a P&L, a report for a company, or we run a report for an office, but it could be that you want to run a report for a region, right? Because you've got a sales manager that's responsible for all of the offices west of the city, and you have another sales manager that's responsible for all of the recruiting in Iowa or Illinois or some state or something. You when you think about regions, you might want to have run reports for all of the offices that are in Los Angeles and all of the ones that are in the Fresno area and all the ones that are down in San Diego. And sometimes it happens that the offices that you own are in different companies. So it could be that you have a manager or a recruiter that is working a region that includes offices that are owned by different companies. And so this is where the use of regions becomes most valuable because in all the normal reports in account tech, you are limited to running either a report for everyone or all your companies and all of your offices, or you're limited to run them for just one office or just one company. But with regions, you can define a region with any name that you want to give it. And you can select a collection of offices, even though the offices are in different companies. And this is a powerful tool that lets you line up the offices in a region with the responsibilities of the managers for that region, regardless of which company has actually legal ownership of the office. So any of the reports that you can filter in Darwin, whether they're financial reports like profit and loss reports, or if they are agent productivity reports or pending reports or recruiting reports, all of the reports can be filtered by a region. And then the result of that report will have all of the offices that make up whatever the regions that you have. Um, I know I'll probably get the question. We are very far along. It's pretty complicated, but we're very far along with a major new product release too. And I'll give you guys a little preview of it. If any of you were on the training that we did last week, I think it was about spotlights for analyzing the performance of a company using spotlights. And spotlights primarily in account tech are filtered by a date range and then by company and then by office. Well, we figured out the technology associated with making those charts and graphs dynamic based on region. So now we're going through all the most popular widgets that you can put on a spotlight, and we're in the process of adding the ability to filter those spotlights by region so that just like you can look at a trend line for how your company is doing or how a particular company is doing or something, you'll be able to run trend lines on how a particular region is doing. So we're pretty darn excited about that. So anyway, that's what we're working on in terms of regions.
And
Now,
Mark, maybe you're going to cover this in a second, but what's the differentiation between regions and divisions? Because I know they're similar but
um,
different.
that is
It may be
that's
later in the slideshow, but I just wanted to bring it up since I saw it on that screen.
no, no, it's not. It's a really good point. And people can and it can be a really confusing point. So I guess we should talk about it for a minute because some people find this a little bit confusing. So a region is a collection of offices. So when you think about an agent production report, you could run it for just one company, you could run it for just one office, or you could run it for a region, which is a collection of offices. So a region as a filter for running reports is a filter for a collection of offices from any of the companies that you own.
Mhm.
Divisions is something very much different, and the accounting on it is pretty complex, interesting, super valuable, but a little complex. So let's explain a scenario. Let's say you're out on Long Island and you're working in one of Lindsay Gallagher's companies, okay? Now you have agents in lots of different offices closing deals. And if you look at the profit and loss for those offices, the commission from those offices is on the P&L and the commission expense is on the P&L. And you run the P&L for that office or for that company, and that's what you report to the IRS. That's the company profitability. Now, let's say last month, one of Lindsay's companies did $10 million in sales and made $20 million in net, I mean, 10 million in sales and did $2 million in net profit. Okay. So it could be that some of those deals that closed last month in that one office, some of them were deals that were put together and run by the new construction division. So they have a new construction division that actually buys land and builds homes and gets those listings. And so some of those commissions that are part of the $10 million in sales last month were deals that were from the new construction division. Now, they're already included in the profit and loss for the office, but these deals happen to be new construction division deals. And they also have, let's say, a relocation division. And of those $10 million dollars in sales, maybe 1.5 million were deals put together by the relocation department. Now, the fact that a deal was put together by the relocation department or put by the new homes department, it doesn't mean that it's not part of the total revenue for the company. It is part of the revenue. It happens to be generated and created by the new homes division or the relocation division. And frankly, the new homes division has its own office and it has labor cost and office supplies, and so does the relocation department. So that division has expenses as well as it has income, but no matter the division, it's all part of the office and the company P&L. But sometimes, especially when you're running a profit and loss statement, you're like, okay, well, that's fine. My office did 10 million. But how much of that 10 million was exclusively from the relocation division? And what were my expenses for the relocation division? Because sometimes you'll see that the income from a relocation department can sometimes be lower than the cost of maintaining a relocation division. And this can be true of any kind of division that you have. You could have a lead incubation division and it could be the labor cost of lead incubation is higher than the total revenue generated by the lead incubation division. So the point is divisions let divisions is kind of like three-dimensional chess. I always say it that way because if you think about normal financials, you have a income account or expense account. So you have an account that you put the revenue to, and you have an office that you put it to. With divisions, you're putting all of your income and expenses to an office. You're also putting it to a GL account, but optionally, you also might be flagging the revenue or flagging the expense for a division. And this is really powerful because then you can say, okay, well, forget about the office for a minute. If I just pull out the relocation deals, how much income did the relocation department make? And how much expenses did the relocation department have? So what is my profit and loss just on that division? So
And are those able to
the
be
whenever you're
cross-company
doing
too? Sorry.
absolutely
Yeah.
100%. Absolutely 100%. And this is crazy important because if you optionally flag some of your income and your expense using Darwin as being not just for this office, but explicitly for this office and this division, it's expense for this office and this division. It gives you the option. Of course, you can just do the office P&L or the company P&L, but you can tease out just the stuff from the new homes division or whatever to see that particular division and the employees that work there. Is it net profitable just in that division? So yeah, that's how divisions um, are are separate than regions, because regions are really just a collection of offices. Sometimes I think divisions accounting is easier to show than it is to explain in words, but we can cover that in tomorrow's
Yeah.
training class if you guys want to. Uh, More questions about that? Because otherwise I'm going to wrap up with the other um, key technologies. Okay.
Keep moving. Yeah.
Yeah. So the other thing I really wanted to talk about, um, the other thing that I wanted to talk about was I want to talk about benchmarking, because if you run a franchise, for instance, like Iron Valley does, or you run a big multi-state operation like Schmidt does or something, one of the things that's really powerful by having separate sets of books by company and lining up those companies side by side is for benchmarking and goal setting. Because if you think about you put all of your companies side by side when you're running a profit and loss statement, you're very quickly able to see, for the most part, all companies should have about $1,000 a month in telephony costs, for instance. And if any companies, with that as a benchmark, when a broker owner or the manager of an office comes and talks to you and says, what should I be spending on my telephone system for the office? Or what should I be spending on copiers? Or what should I be spending on office supplies? By having all of the companies side by side, it's really easy to see if any of your companies are especially good at controlling costs, and you can maybe use those offices or those companies to teach all the other office and companies what are they doing right that's helping them keep their costs so under control. And it's almost impossible to do benchmarking unless you can get all the data normalized and lined up and side by side. I'm working right now on my latest update on EBITDA margin benchmarks for 2024. and the first quarter of 2025. And I'm working on establishing the 2024 benchmarks for labor cost across the nation, across our whole customer base. And seeing what the benchmark is easy if you have all the data normalized, all the data lined up and showing side by side on a report. It's really easy to see the benchmark when you have everything all lined up side by side. And without having it lined up side by side, it's almost impossible to do benchmarking. So you, as in the C-suite of the companies that we run, people are turning to us and looking for advice about how much should I be spending on this? What do people normally spend on this? What's the normal profit margin on my kind of company? What's my normal gross profit margin and that sort of thing? And by normalizing multiple companies in a side-by-side basis, that's how you can get at the benchmarks easily to provide the guidance people are looking for on, what's the target I should be looking for? Where should I set my budgets at? And so I think that's maybe the most powerful thing about multi-tenancy is it allows you to benchmark and give guidance to the people that run, these companies and these divisions, these parts of the business. Well, that's the fundamentals. And unusual for me, finished way ahead of schedule. So does, so let's just open it up for anybody that wants to talk or ask questions about anything.
Yeah,
Adam,
right.
Teresa, do you see anything in chat?
No, but even, I know we've got some folks on here that have been utilizing the multi-tenant accounting, so maybe just even hearing from them how
Yeah, I just saw
help
Keith, I think,
them.
jump in the call. Yeah.
Yeah,
Hey guys,
Oh,
huh.
hey,
how's it going?
Hey.
good.
Can you guys hear the background noise in my office? I'm just curious.
Not
No,
yet.
we just hear you.
You just hear me? Okay, good. I just wanted to make sure. Well, hey, Mark, this was great. I actually took down a ton of notes. Um, Specifically in regards to the divisions. We just recently started utilizing the regions functionality, and I'm really excited to hear about the spotlight enhancements so that we can really start to dive in regionally into some of those reports. We've been using the kind of the multi-company functionality for quite some time just because we own obviously a real estate business, but then we also, under that same entity, and you guys have done some unique things for us. We under that same entity, we actually own a mortgage brokerage as well. And so we wanted to bifurcate those two companies, even though they're under the same legal entity. We wanted to see them as separate companies, and we wanted to maintain separate bank accounts. And so you guys helped us kind of separate those, which was great. And then with our ancillary verticals, escrow. Now we have a variety of DFPI independent escrows here in Southern California. We're able to, really kind of see the P&L stack side by side, which is really helpful for us. But then it also gives us just that consolidated view. So, in one breath, we can see everything kind of separated and individual and see which businesses are doing really, really well and which ones are maybe sucking some wind. But consolidating them and seeing them kind of all under one view allows for us to see kind of a holistic picture, which has been really beneficial for us, especially over the last 2 years, where you're really kind of leaning on some of the ancillary businesses to make up for maybe some of the shortfalls in real estate and lending. So in general, this was really good. I probably got a few questions on the divisions thing that I kind of want to see how that would work for us. But in general, thank you guys for always delivering.
Well, Keith, let me just tell you, tomorrow then, if you or somebody from your team, that's the kind of thing we're going to work on. On every Wednesday, we do a follow-up that's like actually, all right, well, training about what we talked about. So what we could do, if you have anybody from your company on tomorrow's call, we can actually set up the divisions for you and show your people how to use them.
Jesse's from Keith's company is actually saying he can be on tomorrow too. So
Love it.
All
Good.
right. All right. Yeah, well, that'll be perfect.
Cool.
Yeah, because it's not really hard to do. One of the other things that's really powerful that and useful that the guys set up in darwin.Cloud. It's a perpetual problem. Like you close this deal, you close that deal, and it gets to be the end of the month, and you run a report for the reload department director or any division, and you're like, boy, your numbers were down. And they come back to you and they go, no, that's not right. I know I did more than that. I know I did more than that. Well, it's because a bunch of their deals weren't flagged for their division. And
Makes
so
sense.
for
That makes sense.
so for darwin.Cloud, the guys added a feature after the deals are closed, after everybody's paid, after the checks have cleared the bank and everything, you can go back and flag a closed transaction for the right division, and it'll retroactively go find all the accounting records, update them all, and update all the financials for the division.
Wow.
So
That's
it gives you a
cool.
way after the fact to make the divisional accounting records as accurate as possible. So
That's great.
it's a pretty, and I'll teach on how to use that feature tomorrow.
That's awesome. Yeah, we just
Um,
we just got relocation, so that's why my ears perked up.
Mhm.
Mike, what were you saying, sir?
Is that by the side as well then? By list or sale
Yeah.
private property?
Yeah, no, that's exactly correct. Mike just pointed out something really interesting. If you double side a deal, it could be relo on the list side, but not on the sell side.
Mhm.
So account tech lets you set the division by side,
Mhm.
right? Because it could be that your reload director found the seller, but they didn't find the buyer.
Is that on the people page then as well then?
Yes, sir. For the
Okay.
buyer or the seller.
That's what we did. We just put an extra person on the people page called reload division. And so we would just add that to the listing side or the selling side as a person, so the whole property got flagged.
Oh, that's
Because
a
that
clever
per-
way to do it.
Because that buyer might not be buying something next time, and you wouldn't have to remember to take off the reload division on it.
Oh, that's very clever.
Yeah, so it's not
Um,
actually on the pupil record. Okay.
Yeah, well, it's on an extra person record. So,
Right.
Mike,
Mhm.
I'm going to steal that genius idea of yours and train some people how to use that tomorrow, because that's a
Yeah,
very
we call it
clever idea.
type in reload D and it would pop up as a buyer seller on the property, and then now the listing side had reload division on it. Yeah.
Mhm.
Oh, that's very, very smart. That's a really smart way to do it. Because like you said, that person that was from the reload division on this sale, when they sell with you again in 5 years, they might not be.
Mhm.
Right, and you would never remember to take that division off of their profile, so.
Right. Yeah.
Yeah. Yeah. Oh,
Um,
that's very, very clever.
Mark, Brian from NWREB was asking if you're making those division adjustments, does it only work if you're making adjustments to properties that are periods that aren't closed? So if you've closed that accounting period, will that still
No,
work?
because interestingly enough, remember, divisional accounting doesn't change any numbers. It doesn't change any P&Ls. It doesn't change balance sheet. It
Mhm.
just gives you the option of doing a highly filtered profit and loss statement. So for that reason, a period lock doesn't um, a period lock doesn't block divisions from being filled in after the fact, because the division being filled in doesn't change in any way the fundamental financials, which is your balance sheet and your P&L. So you can update those records even in a locked period. That's actually a very good question. One of the things I may not explain this very well. Mike, who's was just speaking a minute ago, might speak about this in a more comprehensive way. But if I understand correctly, one of the things that Mike does is he has an extra company in his software, which is a fake company. It's not even a real company, but that company pays all the bills of all the companies that he owes. So if I'm understanding right, no matter what the bill is, this one fake company, which has a bank account, pays all of the bills, and all of the other companies pay checks to the fake company that paid their bills for them. So in a sense, all the other companies in the company only have one supplier, And the only company they ever write checks to is this accounts payable company that pays all the bills for everybody. I think I said that right,
Not,
Mike, more or less?
not quite right, but, for the
Okay.
most part, yeah, because I mean, in our individual companies, we still pay the agents and franchise fees and that kind of stuff, but all invoices are paid by the accounts payable company and billed out to the individual companies.
Right. So the individual companies pay their agents, pay the referral
Yeah,
companies,
yeah, but
pay
the
the
rents and,
franchise.
invoices are paid from the AP company, and then we do actually just an ACH transfer, a fake check back and forth, transfer lump to them,
Back and forth between the companies.
Yeah.
It's a very clever way to isolate all the accounts payable all in one place.
Yeah. We also do that with our
Yeah.
admin distribution from the HQ company as well,
So when you say the admin distribution, what you mean is cost allocating the labor cost of the people that work in headquarters to
Yeah.
make all of the companies pay their fair share of the overhead.
Right, right. And so I do a distribution of each month to the individual companies, and then it just sets up as a receivable back to HQ. Yeah. And just do an
So
entry a debit to the individual companies and a credit to the HQ P&L to zero out that income statement.
So for folks on this call that have a lot of headquarters staff like NWREB or like Keith, like you do, it makes sense for the accuracy of the individual company P&Ls, right? That they should all be paying their fair share of the headquarters staff overhead, right? And so that cost allocation is a big piece of it.
Do you, so we do corporate allocations and we just code everything into corporate. Is that essentially kind of the same thought? I mean, obviously you're doing it on a much larger scale because you're obviously funneling all of your invoices to this separate entity, but we basically code certain bills to corporate and then we just allocate those across all companies and or branches
It's
based
a it's
on
it's
based on
Yeah.
like
yeah, it's
based on a revenue
yeah,
allocation. It's
yeah, it's just another way of doing the same
got it.
thing.
Okay.
Sure.
Okay. Makes
Yeah.
sense.
Yeah, just another way of doing the same thing.
I like that though. That's clever.
Yeah, well, it's critical if you think about any of you guys that have looked at the spotlight that is profit per agent. When you think about the profit per agent on any of your companies, you can look at how much revenue an agent has made you, how much gross profit he's made you after paying his commission checks. You can add in how much he's given you with monthly bills, paying for private office rent or a membership fee or anything. But then the question is, well, that's fine. That's how much income I've made off the agent. But how much does it cost per agent to have the office open? And one of the things that I see all of the time is that you'll see that the overhead per agent in a given office is really low. And the reason for that is a huge percentage of the company's expenses are coded to corporate overhead and not cost allocated to the offices, as if somehow or other those offices aren't responsible for that overhead. And so it looks like the corporate overhead is really high and the office overhead is really low because like you do it, Keith, it should be cost allocated out. Then you have a really accurate idea of how much per agent does it cost to have the office open. And when you're evaluating if an agent is even worth keeping on the roster, you can't really evaluate them without comparing that to how much it costs to have the office open. And so this cost allocation of the HQ overhead is a really, really big deal. And I think it gets overlooked a lot of the time. So it's great that you guys have this totally under control. What else? And we have a couple minutes left. Does anybody else has questions or ideas or things we could talk about?
Hey, Mark, I also, we just talked about me doing my accounts payable. We also do the same thing with, as an extra company for all of our payroll as well. So the payroll comes in as one entry for the different states, and it's easy to allocate them back out the same way.
Oh, so even though the employees work for all different companies that you own. You run it through one big massive payroll and
Mhm.
then cost allocated out using the intercompany accounting.
Yeah, I get a journal entry right from the Paylocity, and then I upload it into the into the payroll company. So then we just have a fixed amount that I leave in that account to cover payroll every 2 weeks, and then I reimburse them after payroll's run.
Oh, so there's another very creative way of using intercompany accounting
Right.
by consolidating all the payroll all in one place. I like it. I like it. Um, who else has a question or a comment or something that we could dig in on? And again, we'll be here tomorrow at the same time for anybody who has questions about implement some of these things like setting up divisions or intercompany accounting.
Mark, do you want to just pull up the accounttech.com/cloud now just to show where people can see the upcoming webinar schedule and upcoming Q&A as well as where the recordings are?
Yeah, great idea.
Just 'cause I posted the links in the chat for people, but just in case people wanted
Right.
to
So
go slash
if you're
cloud
at the
now. Oh,
yeah, if you're at the Account Tech homepage, there's a button here, Everything About Cloud. And Teresa and Adam have done a great job with this. I think Teresa did most of it, but
yes, I did none of it.
all right. So here's a list of all the webinars, and here's a list of all the Tuesday webinars and the Wednesday Q&As that we're doing for the rest of this, maybe the rest of the year. If we go down, next week, we're going to go over the company store. So remember, in the company store technology, you can make it easy for agents to buy stuff out of your storeroom or buy services from you, or just automate, take the billing for things like photocopies and stamps and take it out of the accounting department and put it at the front desk. So we're going to talk about how to set up the company store for agents to buy stuff from y'all.
And I think at the top of that screen, Mark, is a link to all the past recordings too.
Right.
Yeah.
All the past recordings
So
are here.
if you joined late
And
or missed one of the other ones that we did, you can come here and see the recordings of the ones that we did. So
you can see the recordings of the Tuesday and the Wednesday. The Tuesday and the Wednesday. So here, what are we doing? That we're doing company store next week,
yep,
and then we're going over the agent billing wizard.
Yep.
There is a new feature. I don't know if it'll be out in time for that May 13th date, but there's an exciting new feature coming out. I have to say, can't take credit for it. It was the idea from it came from Century 21 Judge Fight in Texas. But we're making a new wizard that lets you pick from a bunch of different options to evaluate all the deadbeat agents that haven't paid their bills and assess them a late fee automatically, and it calculates it automatically and posts it to their account. So hopefully that'll be done by the 13th, because I'd love to train on how to use it. It's an exciting new feature that's coming out. And then the week after that, we're going to look at document storage in depth, and not just transaction documents, but deposit slips and agent bills and
Invoices,
blank
yeah.
and checks and invoices and the whole thing. So we're going to look at document storage on a whole bunch of levels on the week after that. All right. Well, there we are for today. Thanks everybody for coming to the call.